डॉक्टर बाबासाहेब आंबेडकर ओपन युनिव्हर्सिटी.
Welcome, my dear friends and students, to Dr. Babasaheb Ambedkar Open University, Ahmedabad, in Chaitanya Studio of Dr. Babasaheb Ambedkar Open University, Ahmedabad, in the video lecture series for the program called BBA Regular. In that, we are studied the second block, that is a block number 2 of the accounting, management accounting. In that, unit number 1, that is a cash flow ratio statement and common size statement. Then after, my dear friends, let us discuss the first unit, that is a cash flow, and the learning objectives of this particular unit is that the meaning to defining the meaning of the statement of cash flow, or we can say the cash flow as per the Indian Accounting Standard 7, and significance of statement of cash flow, or we can say the cash flow statement. In a basic introduction part of this particular chapter, or we can say this particular unit of cash flow statement as per the Indian Accounting Standard 7, let us define the what is that particular introduction about it. So a statement of cash flow is a financial report that describes the source of a company's cash and how that cash spent over a specified time period. And it does not include the non-cash item such as depreciation. And this make it useful for determining the short-term viability of a company, particularly its ability to pay bills. And because the management of a cash flow is so crucial for the business and small business in a particular, the most analysts recommend that the entrepreneur study this cash flow statement at least in every quarter. So we can say that, my dear friend, in a general sense, what is cash flow? That is nothing but evaluation of your cash. That is, what are that cash inflow and what is that cash outflow. In the continuation of this, the statement of cash flow is similar to the income statement, or we can say the profit and loss account. In that it records the company's performance over the specified period of time. And the difference between the two is that the income statement also take into the account and some non-cash accounting, or we can say some non-cash transaction over that, such as a depreciation. And while the statement of cash flow strips away all of this and shows exactly how much actual money the company has generated. And the cash flow statement showed how companies have performed in a meaningful inflow and outflow of that cash. And my dear friends, it's also provide a sharper picture of company's ability to pay the creditors and finance growth. So we can say that profit and loss account and balance sheet provide the book value, whereas cash flow statement provide the cash value. So this is the difference. We can say that it's a mighty difference between the what we are talking about, that's income statement and balance sheet and cash flow. So while we are talking about the difference between these three, so we can say that the profit and loss account, or we can say the income statement, and the balance sheet shows the only and only book value, my dear friends. And here the cash flow define what, my dear friends? That is a cash value. So this is also important while we are discussing the cash flow statement. Yes or no, my dear friends? Absolutely right you are. Yes, because it is provided the cash value. In the continuation that In order to bring uniformity in the presentation of account of all the companies and other firms, international accounting standards are prepared. And on that basis, our Institute of Chartered Accountant of India is also providing accounting standard to bring uniformity in preparing and presenting accounts in India. So we can say that, my dear friends, ICAI, that is Institute of Chartered Accountants of India, is one body who provide the accounting standards for maintaining, presenting, preparing that account all over the India. And while we are talking about this particular statement of cash flow, my dear friends, the institute had prepared the accounting standard 7. That is, my dear friend, Indian accounting standard, not only accounting standard, because there is a difference between them. So Indian accounting standard 7 is for preparation of cash flow statement. And it is perfectly possible for a company that is shown to be the profitable according to the accounting standard to go under if there is not enough cash on hand to pay the bills. And the comparing amount of cash generated to the outstanding debt known as a operating cash flow ratio. And we can say that illustrated that the company's ability to service its loan and interest payment. If a slight drop in a company's quarterly cash flow would jeopardize its ability to make a loan payment, that company is in a riskier position than one with less net income but stronger in a cash flow level. So ultimately, my dear friends, we can say that the company's cash flow statement as per Indian accounting standard 7, it's generated and defining how it is used and how it is prepared in your company, and it maintains that uniformity over that particular India. And while we are talking about that particular scope regarding the one country, so we are talking about that only India, so that is an Indian accounting standard 7. And unlike the many ways which reported earning can be presented, there is a little a company can do to manipulate its cash situation and banning any outside, or we can say the outright frauds. The statement of cash flow tells the whole story regarding your cash value. While profit and loss and balance sheet talk about, my dear friends, that is a book value. But when we are talking about the cash flow statement, is generated and defining what is your cash value. And at that position, you easily grab all opportunity. And also, you deducting, or we can say that you justify what your accounts tell about. So the company either has a cash or it does not. The analyst will look closely the statement of cash flow of the company in order to understand its all over, we can say, the overall health of that particular company. So this is one of the important aspect, my dear friends, while we are talking about that cash flow. Next is, what is that statement of cash flow? A statement showing that the inflow and outflow of cash during the previous year, or we can say the last year, and a result that the balance of cash at the end of the year, known as the statement of cash flow. So in a general sense, in a layman language, we can say that that evaluation of your inflow and outflow of cash for that particular specified period of time, which is known as, my dear friend, nothing but that is statement of cash flow. And this statement helped the management to know the actual liquidity, or we can say the liquid position or position of cash on hand. And also we can say that ascertain whether the business are able to get the enough cash to meet the liability as and when they arise or as required. So this is just justified that what is your cash obligation. So ultimately, my dear friends, we can say that that is also defining nothing but we are talking about that inflow and outflow of cash flow, but it also defining how that cash is utilized in your particular business, and whether it is obligatory or mitigating that all expenses or not. So ultimately the cash flow statement is most important because it is defining your cash value. And my dear friends, it is also defining that cash on hand, and also ascertain whether that business is able to get the enough fund, or we can say the enough cash to meet the future liabilities arise or not. Next, my dear friend, that is cash flows are either the receipt, that is a cash inflow, and show are the represented as a positive number in a statement of cash flow, or we can say the payment, that is cash outflow, or we can say that that is represented as a negative number using the bracket in a statement of cash flow. The cash flow are usually calculated as a missing figure. For example, when the opening balance of asset, liability or equity item is reconciled to its closing balance using the information from the statement of profit and loss or income statement, and or we can say the additional notes, the balancing figure is usually the cash flow. The common cash flow calculation include the tax paid, which is operating activity cash outflow, and the payment to buy the property of plant and equipment, that is PPE, which is investing activity of cash outflow, and dividend paid. So in that, my dear friend, first is that operating activity. The most important source of that cash flow, as we discussed in previous slides, is that which is generated by the business operation. And this include the two items in that. The first is profit from operation, and cash flow from change in a current asset or liability, or we can say change in working capital. So profit from a business operation shown by the P&L account does not show the inflow of cash to ascertain the net cash flow due to the operation, and the non-cash item debited must be added back to the profit. For example, depreciation, return of intangible assets and fictitious assets, goodwill written off, or we can say the preliminary expenses written off, etc. So cash flow is affected due to the change in a current assets like debtor, bills receivable, etc. Next is that cash flow decreases due to the increasing in current asset, and cash flow increases due to the decreases in current assets. So there is an inverse portion between that current asset and the cash flow. So we can say about it the current liabilities like creditor, bills payable, etc. So increase in current liability, increase in cash flow, and decrease in current liability, decrease in cash flow. So ultimately give that particular effect of change in working capital, or we can say change in a current asset and current liability over there. The operating activity are the main revenue earning activity of an enterprise. The operating activity can be presented in a two different way. That is a first, that is a directive method, or we can say the direct method, which shows the actual cash flow from operating activities. For example, the receipt from customers and the payment to supplier and staff. And the second is the indirect method, which reconcile the profit before tax to cash generated from the operating profit. And under both of this method, the interest paid and the taxation paid is presented as a cash outflow. The next activity is, my dear friends, that is a investing activity. The investing activities are the securing and transfer of the long-term asset and other venture like investment, not included in a cash equivalent. That investing activity, that cash flow are those that related to the non-current resources like assets. An illustration of that contributing that cash flow incorporated the cash outflow on the buying property, plant and equipment, and the sale continues on the transfer of non-current resources and cash return received emerging from the ventures. Next is, my dear friend, that is a financial activities. The financial activity of cash flow that relate the cash flow arising from the way that the entity is financed. An entity are financed by mixture of cash from borrowings from third parties, that is debt, and by the shareholder, that is equity. For example, financial cash flow include the cash received from new borrowings or the cash repayment of the debt, as well as the cash flow with shareholders in we can say that in the form of the cash receipt following the new issue of shares, or cash paid to them in the form of dividend. So whatever that issues coming over that with respect to your equity, that is ultimately added on that financial activity, and whatever you paid, that is a dividend, that is deducted from that financial activity. So ultimately, my dear friends, we can say that that financial activity, that is absolutely with respect to that particular debt, and you can say that equity. Next point is, my dear friend, that is analysis of the statement of cash flow. This statement of cash flow is one of the most important financial statement for a project or a business. And this statement can be as simple as a one-page analysis, or may involve the several schedules that fit the information into a central statement. In that, the statement of cash flow is a listing of a flow of a cash into and out the business or a project. And think of it as you are checking the account at a bank. The deposits are cash inflow and the withdrawals are the cash outflow. So the balance in your checking amount is net cash flow for a specific point of time. The statement of cash flow is a listing of the cash flow that occurred during the past accounting year, and a projection of a future flow of a cash is called a cash flow budget. You can think of cash flow budget as a projection of the future deposits and withdrawal to your checking accounts. Then a statement of a cash flow is not only concerned with the amount of cash flow, but it also the timing of that flows. And many cash flows are constructed with a multiple time period For example, it may list monthly cash inflow and outflow over a year time. And it is not only project that the cash balance remaining at the end of the year, but also the cash balance for each month. The purpose of statement of cash flow is to show where an entity cash is being generated, that is cash inflow, and where its cash is being spent, we can say that the cash outflows. And over a specific period of time, that is usually quarterly and annually, it is important for analyzing the liquidity and long-term solvency of a company. And the statement of cash flow uses the cash basis accounting instead of the accrual basis accounting, which is used for the balance sheet and the income statement by the most companies. And this is most important because a company may accrue the accounting revenue but may not actually receive that cash. And this could produce the profit and taxes payable but not provide the resources to the stay solvent. The next topic, that my dear friend, with respect to this, that is a working capital is an important part of the cash flow analysis. It is defined as the amount of money needed to facilitate the business operation and transaction, and is calculated as a current asset less current liability. That is liability due during the upcoming accounting period, and computing the amount of working capital gives you a quick analysis of a liquidity of a business over the future accounting period. And if the working capital appears to be sufficient, that developing a cash flow budget may not be critical. But if the working capital appears to be the insufficient, that a cash budget, or we can say the cash flow statement and cash flow budget, may highlight the liquidity problem that may occur during that coming years. The most statement are constructed so that you can identify each individual inflow and outflow of that particular item with a place of describing or the description of that particular item. And the statements like a decision tool cash flow budget provide a flexible tool for that simple cash flow projection. And a statement of cash flow is only the one of the several financial statements that can be used to measure a financial strength of a business. And other common statement include the balance sheet, or we can say the net worth statement, and the income statement, although there are the several other statements that may be included in particular area of that statement of cash. So these are the statements fit together to form a comprehensive financial picture of a business. And the balance sheet or the net worth statement shows the solvency of the business at a specific point of time. And the statements are often prepared at the beginning and ending of that accounting period. And the statement records that the assets of that business and their value, and the liability or the financial claims against the business, that is your debt, and the amount by which the asset exceed the liabilities in the term of net worth of the business. And the net worth reflect the current value of investment in a business by the owner. So this is what, my dear friends, all about that the cash flow statement analysis. And after watching this, you have to evaluate yourself in a three aspects. First, you have to write a long questions. Second, in a short question, you have to write a short question, and then you solve that multiple choice question. And after that, if you want to review or referring the more and more books over there, so you can easily refer that particular book. So in that first aspects, let us discuss the long term, or we can say the long questions over there. The first is describe the significance of statement of cash flow. Then second, write a note on a classification of a statement of cash flow. In a second aspect, define in a short question. The first question is define the cash flow as per the Indian Accounting Standard 7. Next is how the cash flow statement useful in management accounting. After that, solving that the multiple choice question, the first question is that which item is not included in a statement of cash flow. First option is depreciation, that is a non-cash item. So ultimately the answer is nothing but that your depreciation. Then question number 2, that statement of cash flow shows how the companies have performed in a managing. So that is a only inflow and cash flow of the cash or only outflow of the cash? No, it is an inflow and outflow of cash both. So answer is C is absolutely right. Then after, if you want to refer something more with respect to this particular unit, then you may refer this to books over there. And so this is for the today's session. Hope you learn well in this session. Enjoy your day. Have a great time. Thank you very much.
स्वाध्यायः